This episode of the Your Financial Pharmacist podcast is brought to you by LendKey. Now, here's the reality. Your student loans could use a break, and LendKey wants to help. They connect graduates to over 300 credit unions and community banks to offer student loan refinancing through an easy online application. It takes less than 2 minutes to check your rates and see how much you could be saving. And even better, you can get a cash bonus of up to $750 if you refinance using our special link, which is lkrefi.com/YFP. There's no fees to get started, and you can get a further 0.25% rate reduction if you set up auto payments. So check out your rates at lkrefi.com/YFP and see how easy borrowing can be with LendKey. Again, that's lkrefi.com/YFP.
One of the big blunders I see is just totally following like a third party monitoring service. And I don't want to name too many names because there's a lot of them out there, but traditionally these third party services are going to overinflate your credit score more than what we would see.
You're listening to the Your Financial Pharmacist podcast, a show all about inspiring you, the pharmacy professional, on your path towards achieving financial freedom. Hi, I'm Tim Albrecht, and on this week's episode, I welcome back onto the show Tony Umholt, a mortgage manager for Iberia Bank. We discuss 10 common mortgage mistakes home buyers make and steps you can take to avoid these mistakes. To learn more about considerations when getting a home loan and to get more information about the Pharmacist home loan offering, make sure to check out the post on the YFP site titled 5 Steps to Getting a Home Loan by visiting yourfinancialpharmacist.com/home-loan. Speaking of home buying and getting a loan, I want to make sure you're aware of an upcoming free webinar we are doing with Nate Hedrick, the real estate RPH, on all things home buying, and that'll take place February 25th at 8:30 p.m. Eastern. During this webinar, Nate will share what you need to know about purchasing a home in 2021 and will walk you through important steps to take in your home buying journey to make the process easier to understand. You can register for this free webinar by going to yourfinancialpharmacist.com/home buying webinar, all one word. Again, yourfinancialpharmacist.com/home buying webinar. Tony, welcome back on the show.
Tim, thanks for having me.
Excited for this discussion here in 2021 as we have you back, talking about 10 common mortgage mistakes home buyers make and steps that folks can take to avoid these mistakes. And many of these come from either personal experience or ones that we know are often being made. So we're going to go through these one by one and certainly lean into your expertise to hopefully give folks a guide of what are some things that they can be aware of going into the lending process, whether that's a first-time home buy, second time, third time, or refinance. And then hopefully put in some steps to prevent those from happening in the future. So Tony, the first one I have here that I know often comes up is that folks may not fully understand in advance the common loan types and the considerations and differences for each. And so before we talk about the Pharmacist home loan through Iberia, aka the doctor loan, give us an overview at a high level of conventional FHA and VA loans, as I suspect those are the main ones our community will already have some familiarity with and perhaps some experience with. Generally speaking, how do these work? What's the difference between them? And what are some important considerations for lendees when pursuing these types of loans?
Yeah, sure. Great question. And that's definitely the most common types of loans that are out there and that you'll hear about. Fannie Mae and Freddie Mac, we call them the GSEs, which is government sponsored entity. They provide conventional financing. And thank God we have them, right? I mean, they really keep our housing market, alive. And then we have, of course, FHA and VA loans, which are backed by, we call it Ginnie Mae, which is HUD, which is also a government program. And those are, the main key loans that are out there. There's also portfolio products, unique niche products, such as the Pharmacist product that we're discussing, we've discussed that individual banks can hold on their balance sheet as well, which don't have the traditional investor government-backed sponsor, so to speak. But not to get too, into the weeds here with that, but high level, I would say, is conventional products. The main differentiation on that is they will allow a loan amount up to $548,250 in most markets. There is some markets around the country where that's a higher number, such as around San Francisco, Los Angeles. There's going to be a higher loan limits in certain counties and higher priced areas. But that's one of the main pieces with them. And a conventional loan above 80% loan to value, PMI is required. And that mortgage insurance is required to deliver the loan to Fannie and Freddie. So that's why it's so important that you have this mortgage insurance. Lenders require it, and it can be costly, right? That can be very costly. FHA and VA. Let's kind of pull the two apart here. FHA, the Federal Housing Administration loan, is designed for a little bit more flexible credit. Although conventional loans can get pretty low on credit score too, FHA tends to be better if you have lower credit scores because it will allow lower interest rates for the most part. FHA loans, though, typically don't have a loan amount max as high as conventional. So, for example, if a market's 548, 250 for conventional, it might only be like 300 and a quarter for FHA. So I usually utilize FHA as a last resort only when it's the best loan for the client. And then VA, of course, is for veterans. And the VA loans are great. They allow 100% financing with no PMI. The only downside with VA is there's a funding fee that's rather expensive. So I've actually had a few veteran clients that we've actually done conventional because it's cheaper overall. But I could talk a long time on this subject, but hopefully that clarifies the main points.
Great overview. And to our listeners that want to learn more on each of those, you can check out episode 169. Tony and I talked through helpful tips for getting a mortgage, going through different loan products, talked about the Pharmacist home loan, which we're going to segue here and talk about that for a moment, as I think your discussion on PMI is a good lead in. And so as we think about the Pharmacist home loan, Tony, common barriers to pharmacists being able to purchase a home that I've seen is student loan debt, which of course can impact debt to income ratio, as well as their ability to save for a down payment. They're coming out of school, looking to buy a home, 6 figures or more of debt. And I think that's where the Pharmacist home loan can have its value. So tell us more about the Pharmacist home loan option that Iberia has, including minimum down payment, terms, requirements to qualify, PMI considerations, and so on.
Sure. The product we offer to pharmacists, it allows a very, very little down payment, and there's no PMI. So that's probably the key points to it. If you're a first-time home buyer, you can actually put 3% down and have no mortgage insurance. And if you've owned before, it's 5% down, again, with no mortgage insurance. The minimum credit score is 700. And the one piece to this, and again, I always try to avoid interest rates because they're volatile and the market can move, bond market can move. But I have found over the last 18 months that I can offer better rates on this product than if I had a non-pharmacist customer come and put 20% down. I mean, it's very strong interest rates. So it's that's been the two big pieces that I've noticed is just very strong 30-year fixed loan rates. And that no PMI is just huge. I mean, in some cases, if you're buying a $500,000 home and you're putting 3% down, you're talking about a $400 a month savings just with PMI. So it's a pretty substantial number. In regards to student loans, it doesn't completely waive them. And I find most of my clients that I work with are under an income-based repayment plan anyway. And that's what we'll use in calculating a debt to income ratio. But in the case where there isn't a payment, it uses a factor that's lower than a traditional conventional loan or an FHA loan. So it enables more buying power.
Very good. And we covered the Pharmacist home loan in a fair amount of detail, episode 139, ins and outs of the Pharmacist home loan. Also, if you go to yourfinancialpharmacist.com, click at the top, buy or refi a home, you'll see more information there to the Iberia product, as well as to the real estate concierge, Nate Hedrick, for those that are looking for an agent as well. And we're excited about the partnership that we have with Iberia because it's nationwide. And we've got a nationwide community here in the YFP community. I have had the chance to work with Tony now for the better part of a year. Love what he's doing, his passion to educate and help folks on this decision and understand how it fits in with the rest of the financial plan. So that's number one, not fully understanding in advance the common loan types and considerations and differences for each. Number two here, Tony, is credit blunders. And I'm thinking of those that perhaps may overestimate their credit score or perhaps not have a good understanding of how credit scores impact rates, maybe waiting too long to resolve credit issues and so on. What are some of the common mistakes and blunders that you see related to credit?
The credit and the overestimate, you mentioned overestimating credit. I see that a lot. And, I think a couple of things I'll just touch on here with credit. One of the things as a lender, I try not to run credit unless we absolutely have to, right? There's a lot of clients that'll call and just want some, high level information, but credit is so important. And because it's such a critical part of the product, so if you have a minimum credit score of 700 and you're under that, it's good to know why. And some lenders can, and we offer this service as well. We can give you ideas on how to improve it. We actually have scoring models that tell us what your score could go to by doing certain activities. But anyway, one of the big blunders I see is just totally following like a third party monitoring service. And I don't want to name too many names because there's a lot of them out there, but traditionally these third party services are going to overinflate your credit score more than what we would see. Like us as so for example, a creditor is going to see a score that is maybe 30 points on average lower than what you might see on one of these services. And I subscribe to a service, I will say I do, but it gives me good trends as to what my score is doing, but it's not what a creditor will see. So in my lifetime of lending, the highest credit score I've ever seen was 820, and it was an 80-year-old gentleman who had perfect credit his whole life. So it's one of those things where, when I have customers say, hey, my score is 850. Well, that's what the monitoring service says, but it's really not going to be that way when we see it. So that's one thing, a blunder that I see. The other is the misconception on an inquiry as well. A lot of inquiries is not good, but a couple inquiries at one time for a loan is not going to have an effect on you. There's a window of time where you can do this. So that's another piece. And then the other really important one, and I can't stress this one enough, is the no interest for a year type cards and promotions that are out there. And it's very tempting to go to Best Buy and they'll offer you a $5,000 credit limit for $5,000 worth of stereo equipment and maybe TV, whatever it might be. And you don't have to pay interest for 2 years, which is great, right? It sounds great. But what they do is they report that to the credit bureaus, which is Experian, Equifax, and TransUnion, as 100% maxed out credit card. And I'll confess, as a young man, I was in my early 20s, I bought furniture for one of my first house with a store called Rooms to Go, and I did this, right? And that's how I learned. And of course, I've seen many clients do this since that time, but it actually happened to me personally. I said, wait a minute, how did my credit score go from 750 to 660? And that was one of the things that happened. I did this credit, it was a maxed out credit card. That's how it's reported to the bureaus. So that's another big blunder, Tim, that I see.
Yeah, and credit, great summary, Tony. Great insights there as well. Credit optimization, credit security, such an important part of the financial plan. Obviously, we're talking about here related to securing a mortgage, but generally just an important piece to consider. Tim Baker and I talked about this on episode 162, Credit 101, talking about what is a credit score, breaking that down, 6 factors that can impact scores. So if you want more information and better understanding your credit, we'll link to that episode in the show notes. So that's number 2 here, credit blunders. Number 3 is not shopping around. And I know, Tony, that, rates, especially in a market where I feel like access to information has become easier to find, if you will, that rates may be not necessarily what I'm referring to as much here, although that, of course, is a consideration. And I think in some cases, if you've got good communication with the lender and rates are changing, that they'll be in communication with you. So I think that relationship certainly is important. But obviously, we know not all offerings are created equal. So here we're talking about the Pharmacist home loan. Folks may or may not be aware of that. And so looking at a few different institutions, understanding the products that are out there. But what else, Tony? What are some things that folks may notice beyond the offering and perhaps beyond the rate that would be different from one bank from another? I'm thinking about things like application fees, document fees, other things like that folks should be thinking about as they shop around.
I really think and it can be very challenging sometimes with the shopping around because there's different levels of knowledge out there. And some of the companies, are just set up as call centers and they funnel internet leads in. So there's different knowledge bases that you're going to speak to sometimes. So I find that sometimes adds some confusion. But I think it is very important to find the right product. I think that is very much a critical element. So finding the lender that has the right product for you is important. And I never, want to. I'm very sensitive to relationships. I have people call me and say, "Hey, I've used this lender for 10 years, and they've been always been good to me." And we're a competitive industry, but sometimes if I think something's better, I'm very quick to tell that person this other lender has a better product. So I think, and I actually have a lot of lenders that will actually send me clients that they know we're better fitted for. The fee part is important because there's only really one set of fees the lender controls. And that is there's a lender portion of fees. The rest are third party. So they're going to be through third parties. It's going to be the same, really, no matter who they use. So that's one thing I find that confuses a lot of people is, they'll consumers will lump in the prepaid expenses, taxes, insurance, title insurance as well, and doc stamps for the state that they're in or the county, recording fees. But those are going to be the same cost no matter what. There's really only one line item of lender fees that are going to be different that could vary. So that's one way to look at the lenders, just lender fees and interest rate. Really, that's as simple as that. But the biggest things I find when you're looking, when you're out there, and again, I'm not going to name names of companies, but when you're looking to buy a home and you have there's a lot of companies that have popped up, especially internet-based companies that are really just feeding off the refinance, market. It's hard to be equipped for purchases because when you go under contract for a purchase, you have a commitment letter date, right? There's a commitment financing contingency, there's appraisal contingency, there's all these contingencies in a contract, and you want to make sure the lender is watching this and can meet these milestones. A lot of lenders that are set up for refinances just aren't set up for purchases. It's okay, it's okay to use one of these lenders if you can wait 90 or 120 days to close your loan for a refinance, but on a purchase you can't do that. So service is very important when you're buying a home. It still can be with refinancing, but you can always just wait longer. It's just one of those things. But I would just say you really have to be careful with the service aspect when you're buying because it's a very competitive housing market right now. And a lot of these sellers have backup offers. I get called a lot too because people are under contract and something went wrong with their lender and I have to jump in sometimes. So I see it even as a secondary lender when things go wrong with the original lender. So I would just say the big thing is a comfort level with that person and that organization. The best rate and product is important too, but also making sure that you're in the best fit for you. Because one other thing I will say is, if you can get a better rate putting 30% down than you could putting 5, but that's going to use up all of your liquidity and maybe impact other financial planning aspects of your life. Well, the 5% is much better, even if the rate's a little higher. So I think it's very important to plan, look at your overall plan. That's why the folks at YFP are so great to work with because they can look at everything and say, hey, this is better for you in the long run because of this. So I hope that's helpful. I mean, there's a lot of components to it. There's a lot of things to think about, but I think it's really finding a comfort level with the group that you want to work with, and especially if you're buying a home.
Absolutely. So point number 3, they're not shopping around. I can speak from personal experience working with more of a big box company, obviously having the opportunity to work with you guys, open communication lines, feeling comfortable with the process, getting questions answered. All of that really matters. Number 4 here is looking mistakes. Again, we're talking about here, looking beyond, of course, a simple Zillow or Redfin search before you get pre-approved and know what you can borrow, which is not necessarily, of course, the same thing as what you can afford, right? We talk about this with Nate Hedrick on the podcast a lot, the Real Estate RPH. What you can borrow, what you get approved from the bank is not necessarily what you can afford. And that connects, Tony, to what you just said about connecting this home buying decision with the rest of the financial plan. So talk to us here briefly about the importance of the pre-approval process.
The pre-approval process is critical just to know what you can afford both ways, right? To see if that Redfin search popped up a house that you can't buy. I've also seen it the other way around where, with the rates being so low, clients have said, "Hey, I'm paying $2,900 a month for rent and I can buy more house than I thought I could." So it's really just critical in the education process. Knowledge is so important and just knowing what you can and can't do is important. And the pre-approval process will allow us to see if there's any red flags as well. we've had, lots of clients that we've been able to help get their credit scores up a little bit higher. We've had lots of clients that, both ways have said, hey, I don't want to buy a home this large because I didn't realize, that this is the cost and the taxes are this. And on the other side, I've seen it the other way too, like I mentioned. It's very important to get pre-approved before you start walking into houses. And I will say that the realtors are very proactive right now because of the tight inventory. We get a lot of phone calls from the listing agents even. And of course we can't give much information away, but they're calling us, hey, are these clients approved? I mean, it's a different market in a lot of parts of the country right now.
That makes sense given where we're at in the climate of the market. So number 5 here is underestimating the cash to close. So what I'm referring to here, Tony, speaking from personal experience on our first home purchase a little over a decade ago, is that I think many folks, when they're looking, look at the sale price of the home, they might say, okay, I'm going to be able to negotiate this or this, which might be overconfidence, especially depending on what's happening in the market. And they're probably thinking about the down payment, whatever that would be, 5, 10, 15, 20% down, but they might not be thinking about other costs that they're going to need to consider having cash to come to the close. So tell us about, not numbers per se, but what are some of those other things that folks need to be thinking about when it comes to cash to close beyond just the down payment?
One of the big pieces too, outside of the down payment, is your insurance premium. And insurance is due upfront, full year premium upfront. Even if you paid cash, you have to pay for your insurance premium upfront if you want your home insured. And I find that, and then there's flood insurance as well. If you're in a flood zone, that's due as well. But the insurance component is something you have to take into consideration. The other piece outside of the down payment is your tax allocation. So normally lenders will take anywhere from 3 to 4 months of your property taxes for the escrow account. And for example, the reason it's 3 or 4 months is there's always a 2 month cushion that's collected. But there's also, let's say we were to close today, right, on a house, February 5th, your payment is not going to be due. Your first payment's not due till April 1st. So we have to collect February and March to be on pace to pay it next year for you. So you're going to, we're going to collect 4 months of taxes at closing to kind of cushion things. So, and then of course there's closing costs as well. So there's the prepaid element, and then we have the closing costs. So in addition to the down payment, you have those elements as well. The other thing to keep in mind too, that is some confusion that I see a lot with first-time home buyers, especially, is when you give a deposit on the home. So let's say when you give the realtor, your realtor helps you with the contract, you have to put $5,000 in escrow or deposit. Terminology is about the same, but different parts of the country call it something differently. That $5,000 gets credited back to you at closing. Okay, so that's a contribution to the overall transaction. It's not something that you lose or gets lost in any way. It comes back to you. So if your cash to close, let's just say, was $10,000 and you've already given five, well, you only are going to bring 5,000 to the closing. So that's another piece just that questions that come up.
Very good. And I think the point here I want to make, especially for folks that are on the home buying process for the first time, is making sure you're appropriately considering what might be the cash needed, down payment, closing costs. You mentioned the insurance, the taxes, and some other things as well. So making sure to plan for that in advance, and of course thinking about how that impacts other parts of the financial plan. So we're halfway through our list of 10 common mortgage mistakes to avoid. We're going to rapid fire these last 5. Number 6 here is delayed communications with the lender, title company, and agents. Lots of folks involved, Tony, in this process, lots of moving pieces and parts. And I suspect this is the time to over communicate and set communication expectations with the team in advance. So talk to us about, from your perspective, what you're expecting of obviously your team, but also in terms of folks that are working with your team when it comes to communication.
Communication is critical, and that's what makes the transactions, makes or breaks them in a lot of ways, is communication. So we really try to over communicate with the client. The title companies can be tricky because some of them are, larger, big box, and they'll just send, blanket emails out, and it's hard to get in touch with someone individually. But I think it's, one of the things that I think is critical is that we know who the realtor is and we know who the title company is. And then we know the individual and contacts, and it usually goes very smoothly if that's the case. So just having everyone on board. Normally, the realtors are very important for us to know because we have to we have to give the appraiser their information typically to show the house. But yeah, the title company portion is very important, and especially as we get closer to closing, because the bank or lender's closing department is going to communicate with them and balance the figures for closing.
Very good. Yeah, I think with lots of parties involved, communication always two-way, but making sure that you're being proactive in that, and of course, if there's questions that are outstanding, making sure you're reaching out, and vice versa to stay on time and on track with closing. I'm going to take number 7, 8, and 9 because they hit home for me personally, and then we're going to bring back Tony here talk about number 10 related to mortgage discount points. Number 7 is making a home buying decision before you are ready, just because quote rates are good or because I'm renting and throwing money down the drain. Now, we've talked about this extensively. I'd point to episode 113, is your home an asset or a liability? We've talked about not only the pressures to buy a home, but also the costs of home ownership and comparing renting versus buying. And so I would encourage folks, as we say on the show over and over and over again, to avoid the trap of making any financial decision in a silo. So here, if you're talking with somebody and rates are good, or you see a commercial about rates, or that's the center of the conversation, or somebody says, "Hey, why are you renting? You're just throwing money down the drain." Now, you may conclude that it is the right time to buy, but the point I'm making here is to take a step back. What else do we have going in the financial plan? Working with hopefully a financial planner to help you evaluate that decision, look at all pieces of the puzzle, and then proceed with the home buying decision and the budget to buy a home if it makes sense in the context of your plan. And that really is number 8 in terms of these mistakes, is not thoroughly evaluating how home buying fits in with other financial goals. And so I think as we talk about extensively, if you're looking at 6 figures of student loan debt, you're looking at investing goals, you've obviously got other competing priorities for your finances, home buying just being one of those. How does it fit in? And of course, YFP Planning, our fee-only comprehensive financial planning team, can help that. You can schedule a free discovery call to learn more at yfpplanning.com. Number 9 mistake here is not thinking about available cash post-close. So we talked about how much money you're going to need to be able to come to closing, but what about things like a rainy day fund to make sure that if something goes wrong in the home? What about things like furnishing the home? What about things like yard equipment? And so thinking about not only the cash that you're going to need to bring to closing, but also, do you have some reserves? Do you have some cushion? What will that look like month to month, as well as some funds that you have in reserves to be able to handle some of those expenses that will inevitably come after you move in? And Tony here, number 10 in our list of 10 common mortgage mistakes, I think, is misunderstanding or evaluating mortgage discount points, especially as folks are comparing rates among institutions or even within a lender. So talk to us exactly about what are discount points and ultimately how folks and tips for folks as they're evaluating discount points as an option.
I would recommend that you always ask for a no point quote initially, because some lenders will put that into their pricing. It's funny, even the Freddie Mac rates that are posted in the Wall Street Journal, they typically have 0.6% points in the quote. So, I always say that if I put that in there, the rate would be even lower. But that's really the important element here is discount points. Let me just explain what those are. They are actually, it's defined as prepaid interest. So you're basically buying down the interest rate. And for a finance person, it's like you're buying down the bond rate over time by paying a point. It's like a premium. It sometimes can be a good investment, but most of the time I don't recommend it. And the way that you can tell if it's a good investment is traditionally on a 30-year fixed, 1 point will typically buy down a quarter in rate, typically, sometimes 3/8 of a point. Well, let's say it's a quarter, over 4 years, you basically pay off the point you paid, and then you're kind of in the money. So as long as you own the home more than 4 years, you're in the money. And then a lot of times, depending on your tax bracket and everything, you can write off that point in the year that you pay it. So if it was 2021 and you paid 1% on a $300,000 home, let's say, that'd be $3,000. But the spread in rate is important in determining if paying points makes sense. But I find that it typically is not the best way to go unless there's a big spread. Like there was a time earlier in the year, especially on jumbo mortgages, larger loans that are above the conventional limit, where we were getting a half point for 1% fee. Well, that made sense all day because you had a 2-year payback period on a 30-year fixed. And then you were in the money for the remaining 28 years if you stayed there. So for long-term people who are going to be in the home or own the home long-term, it can make sense sometimes. But to compare lenders, you really just want to ask, like if one lender offers you let's just throwing out numbers, 2.75 with 1 point, and the other one offers you 3% with no points, you can ask the 3%, hey, if I was charged 1 point, what could I get? What could my rate be? And if they came back and said it's 2.625, well, the offer from the higher rate person is actually better in that case. So that'd be one way to compare. But that's a quick summary of points.
Yeah, great discussion there on points. I know that comes up a lot. And I think what we're trying to get to, Tony, is an apples to apples comparison, the best that we can to evaluate it. And I think you bring up another good point in that discussion, which is the longevity that you may be in the home. And I know that's an important consideration, one that folks may not be able to predict in advance, but to try to objectively evaluate that the best you can, because that's going to impact when you think about rates of the loan, when you think about things like points, when you think about down payments and other issues and having to be able to expense a move in the future and closing costs and selling the home. If you know that runway is going to be long versus that's going to be potentially short, that could have a significant impact on many parts of the home buying process. So there you have it, 10 common mortgage mistakes home buyers make and steps that you can take to avoid these mistakes. And to learn more about considerations when getting a home loan and to get more information about the Pharmacist home loan offered by Tony and his team at Iberia, make sure to check out the post on the YFP site titled 5 Steps to Getting a Home Loan. And you can get there by visiting yourfinancialpharmacist.com/home-loan. Or if you just go to the main page, yourfinancialpharmacist.com, top, you'll see buy or refi a home, and that will get you there as well. So, Tony, appreciate your expertise as always, and appreciate you taking time to come on the show today to talk about this important topic.
Tim, thanks for having me. Really enjoyed it. I always do, and appreciate the partnership here.
Thank you very much. And as always, if you like what you heard on this week's episode of the Your Financial Pharmacist podcast, please do us a favor and leave us a rating and review on Apple Podcasts or wherever you listen to the show each and every week. That'll help other pharmacy professionals find the show. Appreciate you taking the time to join us. Have a great rest of your week.